Today we're going to be talking about how to trade earnings like a pro. Before I get started, can everyone hear me? If you can hear me, please type yes into the chat window. Okay, great. Now, just so before I get started and start talking about options trading and trading earnings, just with a raise of hands, how many of you guys are familiar with trading options? If you're familiar with trading options, type in options into the chat window. If you're new to options, type in no. Okay, so a few people here who have traded some options and quite a few of you who have not. Okay, so we'll talk about how to use options as a strategy to trade earnings with limited risk. That's really the key here. So today we'll talk about what trading earnings involved, what you can expect to see around earnings, how do stocks move around earnings, and then lastly, what happens to options around earnings so that you can understand what are the scenarios that you should use options in order to trade earnings. So today I'll talk a little bit by starting off talking about the earnings season preview. So this part has nothing to do with options. This is just talking about what's currently going on in the market, what are our expectations in Q4 earnings, talking a little bit about also what happened last quarter because that helps frame what we're expecting going forward. I'll talk a little bit about what is trading earnings, meaning what do we see, what are events that happen around earnings and why we're interested in them. I'll talk a little bit about why you should consider trading earnings or looking at whether or not earnings is something that you want to trade. And then lastly, we're talking about how can you actually trade earnings effectively. This is the most important piece because this is where we get into the details about how do options allow you to take bullish or bearish views on a given stock going into earnings with limited risk. That's really the key here. And then lastly, like I said, we're going to spend most of our time using the actual platform, showing you real examples of some upcoming earnings and showing you what strategies you can use to take advantage of a few different stocks that I have in mind here today. Now, before I get started, one thing I do want to say is that trading earnings is a risky strategy. It is a binary strategy that generally provides either a high amount of, generally entails a high amount of risk and can sometimes give you nice big returns in very quick amount of time, or it can also lead to very large losses in a short amount of time. So before you get into trading these types of strategies, make sure that you understand the risks before you go ahead and place one of these trades. We're going to go through as many examples as possible to show you what are the risks while we take a look at what are the potential rewards you have by trading these types of strategies. So I'm just going to start off talking about what we saw last earnings season. So last earnings season was reporting from Q3 in the Q4 period. During that time, we saw a pretty strong quarter. The earnings per share or the profits of companies, generally speaking, came in above forecast for the S&P 500 stocks. So we had a pretty strong quarter last quarter. S&P was up quite a bit during that period of time. So that was certainly a good quarter from an earnings perspective. The headline that we really saw that changed from Q2 to Q3 was that CapEx guidance ratios were higher. So CapEx refers to capital expenditure. And what that means is we saw companies being more confident about spending money in order to grow their companies. This happens, generally speaking, when you get executives who feel a little bit more confident in the economy. They see strong growth overall in terms of GDP. These are the types of times when companies will invest in helping grow their companies. So we saw that as an interesting guidance that we didn't see for quite some time. We didn't see companies spend more money in order to grow. We just saw them cutting costs. So this is an interesting trend that we think will continue going into Q4. And the last thing I want to talk about what happened last quarter was the fact that we had relatively muted positive responses, meaning stocks that beat their earnings didn't really see a huge gap higher in their stock prices. However, in the stocks that missed their earnings, we saw a huge negative shock to their stock price afterwards. So this has been a trend for a couple of quarters already, and we expect that to continue next quarter. So those are some of the things to consider. So if you're expecting a a company to miss, or you think a company's going to miss, you might see a larger move to the downside than you might see a company move to the upside if they beat earnings. So let's talk a little bit about what our expectations for the earnings seasons that just started effectively what is last week. So far, the forecasts show pretty strong sales guidance, so meaning we expect sales to be pretty strong going into Q4, so top-line revenue growth, we expect that to be pretty strong. There are a few things such as tax reform that adds a bit of uncertainty. We had a major tax bill go through at the end of 2017, and the impacts of that we're still trying to figure that out. We had some companies come in and say that they expect to have a one-time tax loss for some of the tech companies, some of the banking companies. These are the types of ones that may have a large one-time change to their revenue or profits because of this new tax reform. It's hard to tell exactly whether those will come in Q4 or Q1. So it's still a little interesting to see how that's going to play out. The early reports so far, so we've only been into this earnings season about 2 weeks, less than 2 weeks, and the early and the stocks that have reported very early have seen a very, very strong season. Some of the strongest early reports that we've ever seen on history. So that usually points or correlates to a relatively strong earnings season going into Q4. And the only two things to keep an eye out for is the US dollar and oil prices. These might have a bit of impact on things like energy companies that are very sensitive to oil prices. We finally saw the oil prices have a nice uptick going into the end of last year. So we expect some energy companies to have some interesting positive surprises. And also the US dollar has been relatively weak last quarter. So we expect some multinationals or stocks that generate a lot of their revenue overseas to potentially have some benefit from a weaker US dollar. So these are the types of things that we want to look out for Q4. So, and this is relevant whether you trade options or not, even if you're a long-term stock investor. These are things that you want to be aware of going into every earnings season. So we want to talk a little bit about what our expectations for the different sectors going into Q1. Like I said, because of oil prices picking up towards the end of last year, we do expect energy to be an interesting sector to look at. We expect some beats coming out of that. Out of that sector, I actually have a specific one that we'll look at today. Technology has consistently been a strong sector in 2017, and we expect some of that to continue going into 2018. On the negative side, downward revisions. These are stocks that have guided us lower on either sales or profits. We've seen sectors in real estate. Real estate's been hit pretty hard going into the end of last year and the beginning of this year. So we expect that trend to continue lower. Healthcare and telecommunications are also two of the sectors that have screened relatively poorly compared to the other ones going into earnings season this year. The other thing that you might want to consider is utilities. This really doesn't have much to do with earnings per se. It's just that when interest rates spike up, we tend to see a continuation downwards for utilities. So that's another sector to look out for potential downside moves on the real estate, healthcare, communications, and possibly some on the utility side. But that's not because of earnings. That's just because of other macro factors such as interest rates. So let's talk about what are trading earnings. We'll start off with kind of what are earnings. Earnings are simply just a company reporting its revenue, profits, and providing forward guidance as to what they see their expenditures will be or what the outlook looks like going forward. And when they report these revenues and profits, what we do is we match them against what are expectations from analysts on the street. And depending on whether the report is better or worse than our expected analyst reports, that's kind of what we call beats or miss. And these beats or miss tells us why we should trade earnings. The reason we should consider trading earnings is because These beats and miss creates a tradable binary event with extreme volatility. Now, a lot of people might say, well, volatility sounds scary. That's not what I want. And that's okay. Not everyone wants to trade high volatility events, but earnings is one of those. So if you're looking for potentially trying to take a bet and make some money very quickly, earnings provides that catalyst or provides that binary event that gives you that volatility in order to potentially make a short amount of profits in a short amount of time. However, that also means that you have a high amount of risk in a short amount of time. So that's why we want to take a look at how can we trade earnings effectively. And the answer to that is using options. And the reason for we want to use options when we trade earnings is because by buying calls and puts or buying options, you can limit the risk of a strategy. So even if the stock completely goes in the opposite direction that you expect it to, you have a predefined risk level that you have when you're trading options, so that no matter what happens, you can only lose up to a certain amount. And that's the real reason why, if you ever want to trade earnings, options should be the vehicle that you should be looking at in order to trade earnings. Now, how can you use options to do so? Number one, you choose an expiration date. That usually is about 2 to 3 weeks beyond the actual earnings date. So if you have an earnings next week, you might want to trade a 3 to 4 week option. And this is because most of the time after the stock beats or misses an earnings call, it will usually continue going in that direction, usually by a week or two afterwards. So you do want to give yourself some time beyond just the earnings date in order for your strategy to be profitable. So that's something to keep in mind. When you're picking expirations, you generally want to pick at least 2 to 3 weeks out after the earnings date. And I'll go through some examples in a few minutes to go through kind of picking different expiration dates and seeing what the differences are. And lastly, we buy call and put options to speculate on direction, because when you buy call or put options, your risk is limited to how much you've paid for that option. So even if you're completely wrong, your option becomes worthless and you lose what you've paid. You know exactly how much money you have risked before you get into the trade, so that no matter what, your risk is limited. So this is vastly different from buying a stock before earnings, because if you buy a stock before earnings and earnings misses on earnings, then you could potentially lose a lot of money, and that amount of money is not well defined. So using options allows you to clearly define your risk before you get into an options trade, especially around earnings. So what I want to do is talk a little bit about what happens to options pricing right around earnings, because this is extremely important to understand the different factors that affect your option price in order to trade earnings effectively. Now, trading earnings is not easy. And the reason for this is because I call it 1 step forward, 2 steps back, because you have one thing that can potentially be working in your favor when you're trading earnings, while you have 2 other things constantly working against you. So the odds are already stacked against you. So it's really important for you to understand what the things that affect an option price around earnings is in order to trade them effectively. Number one, this is why we're trading earnings. There's a large stock move on beats or misses. This is what's going to work in your favor, right? So if you expect, let's say, Netflix to beat on earnings and they actually beat their earnings, then you are going to expect Netflix to move up in price substantially over a very short period of time. That's really what you're betting on. You're effectively thinking that the stock will move either significantly higher or significantly lower, and you're essentially betting in one specific direction. That's working in your favor. But at the same time, there's 2 things that are working against you. Number one, this is what we call the volatility crush. So volatility, because right before earnings is very uncertain, so you have lots of volatility. Once that earnings announcement is made and we know exactly what the earnings are, volatility comes back down. And that will actually affect the price of your option. So option pricing will actually decrease in value right after earnings. So you have volatility working against you. So even if you're right on direction, volatility will always work against you, and time will also always work against you. Every single day you hold on to a long option, it decays in time, it decays in value as time goes by. So these 2 factors of volatility and time are always working against your directional move that you're expecting in the underlying stock. So that's why trading earnings, you have to be very sensitive with timing. You want to try to get in and out very quickly right before earnings, and as soon as you feel that the move is done, get out immediately, because volatility and time is always working against you. And the only thing you have to make up for it is a large move in the underlying price, okay? So those are three very important things to understand, and I'll go through them in real examples once we get onto the platform. So because of this interesting scenario where you have one thing working against you and one thing working in your favor and two things working against you, there's really only 1 out of 4 possible scenarios where this strategy is profitable, or you will be profitable when you're trading earnings. So it's extremely important to understand what scenario you need in order to be profitable. So what that means is that not only do you have to pick a direction, it also has to have a large enough move in that direction in order for you to be profitable. So if you call Netflix is going to beat earnings and it does beat earnings, you also need it to beat earnings and have a large move in order for you to be profitable. If, let's say, you call out the correct beat and Netflix does beat earnings, but let's say it only beats earnings by a little bit, or maybe even though it beats earnings, it provided negative guidance, so the stock really doesn't move very much, or maybe even moves lower. So in that particular case, you've picked the right direction, but the stock didn't move far enough in your favor, you're still going to lose money. So this is obviously something that you need to be aware of before you place an earnings trade. And obviously, if you pick the wrong direction, no matter what, whether if it's a large move or a small move, you're going to lose money. The question is just how much money you're going to lose. So keep that in mind. Not only do you have to guess the right direction, it also has to be large enough of a move in order for you to be profitable. So keep that in mind. We're going to go through some real examples in a few minutes. So we talked about having one thing working in our favor and two things working against us. So some of you may be familiar with what's a metric called the options Greeks. And this is not necessarily meant for you you don't have to memorize this, because we show you how to do all of this stuff on our platform, and you don't have to remember how to calculate it because we do it all for you. But I do want to teach these concepts. So we talked about if the stock goes in your favor, you want to make sure that you know how much you're going to get in return if the stock does move in your favor. And that's really what delta is designed to measure. It will tell you how much you can expect in terms of the change of the price of the option in respect to the change of the price of the stock. So if the stock goes up by $1, how much do I make on the option? So for example, if you see a delta of 0.50, that means for every $1 the stock moves up, your option is going to move up by 50 cents. Okay, and now we talked about volatility. We know that volatility tends to come down after earnings. So the question is, how does that impact your option price? That's measured by Vega, or the change in price of the option in respect to the change in volatility. So if you look at an example with the stock where it has a Vega of 0.25, that means for every 1% of volatility that the stock decreases by, you're going to lose 25 cents in value for the option. Okay, so sometimes you might see a 5 or 10% move in volatility after expiration. So that may cause a very large percentage of your option premium or option value to decay right after earnings. So it's important to understand how much decay is there. And that's what Vega will teach you. And lastly, theta. So we talked about options. As long as you hold on to an option, it will decay in value. And the question is, how much does it decay by? And that's what theta tells you. It's a change in price of the option in respect to time. So if you see a delta option with a theta of 0.1, that means that the option will lose 10 cents in value for every day you hold on to it. That's why timing is very sensitive as well when you're trading options, when you're trading earnings, because every day you hang on to that trade after an earnings date, you're going to keep decreasing in value because of theta. So you want to get in and get out as quickly as possible. Okay, so with that, I just want to talk about two main strategies that you would use if you're trading earnings. Number one is you can buy a long call or a put, or you're buying a call or a put. These strategy provides unlimited profit potential. So this is where you think the stock's going to make a very large move, and you think that the stock is really going to beat or miss on earnings, that you would want to buy a call or a put for these types of strategies. So this is useful for when you expect a big move in the underlying on the stock. However, this strategy does put a larger amount of capital at risk. Actually, the largest amount of capital at risk in order to get this unlimited profit potential, you have to pay for it, and you're paying for it by just buying a call or a put. Now, for those of you, an alternative strategy to trading is actually buying a call vertical or a put vertical. This strategy has limited profit potential, and it's really used if you expect a modest or more slower move. So a lot of stocks, they might beat on earnings, but it might take 2-3 weeks for that stock to continue moving higher, meaning it doesn't just move immediately right after earnings. So if that's the case, that's when you want to trade a call or put vertical in that particular case. If you expect a smaller beat, or if you expect a beat that will move relatively slowly. Now, this type of strategy does put a smaller amount of capital at risk, because when you're trading a vertical, you're buying one call, but you're also selling another call, and that helps offset the cost of the trade, and also helps offset some of that time decay. And lastly, you generally, when you're picking calls and puts or picking these call verticals, like I said, you want to pick expirations that are at least 1 to 2 weeks past the earnings date in order to trade that. Okay, so I've covered a lot of things. I don't necessarily expect you guys to remember everything. So that's why I really want to go through some real examples using the platform to actually show it to you, so that when you guys finish this webinar, I want you to be able to log on to Options Play, which you guys have access to for free through your first trade account. I want you to be able to type in a stock and start looking at some earning strategies right after we're done with this webinar, okay? So that's the goal here. So for those of you that are new to Options Play, or you have never seen this platform, you can find it under your trading tab. If you click on the options page under your trading tab, there's a button here on the right that says Options Wizard, okay? I highly recommend you to take your time, go through this, launch the Options Play widget, because that will show you everything that we're gonna walk you through today, okay? So, you know, earnings season is coming up. One of the sectors that typically report earnings relatively early is the financials. And if you look at the financials, it's been an interesting sector to look at. So I'll take a look at some banks today. So as you can see, financials, it traded within this pretty tight range all through December. And just a few days ago on January 4th, and this is when it really kind of broke out above this trading range and started to move higher. So we might expect some banks to potentially beat on earnings. It'll be interesting to see as we get some banks reporting next week. So I wanted to bring up Bank of America. And this is not a solicitation to trade Bank of America or to say that I think Bank of America is better than any other banks. I'm just simply using it as an example because it's a very widely traded stock. A lot of you are familiar with it, so I'm just using this as an example. This is not a solicitation to trade Bank of America per se. So when you pull up Options Play, you'll have trade ideas and watch list on the left. You have our equity analytics panel here in the middle, and then we have trading and income here on the right. This is designed to help you walk you through everything you need to know before you place a trade. So when we look at Bank of America, we can see that the earnings are in 6 days on January 17th. So coming up, it's very soon. So let's take a look at some strategies on how to take advantage of Bank of America. So as you can see, when I type in Bank of America, I automatically am presented with 3 strategies here on the right. I can buy the shares, I can buy this call, or I can buy this call vertical. So before I even look at any specific strategies or take the things that I've just taught you from the other slides, let's just take a look at, if we just kept these 3 default strategies, we didn't do any modifications, what happens? So I'm looking at Bank of America. We know that it reports earnings on January 17th. So that's where we're going to use our P&L simulator here on the right. And we're going to simulate what happens if Bank of America beats earnings, what happens if it misses earnings, and see how each one of these strategies perform. So here, we know that the stock reports on January 17th. So I'm going to choose a date just a few days after January 17th. Let's choose January 20th, 3 days after earnings. The stock's trading at $33 right now. So let's say, what happens if I think the stock's going to go up to $32? And like I said, we know volatility comes down right after earnings. So volatility is pretty high right now at 22% on Bank of America. So what happens if volatility comes back down to, let's say, 17% roughly? Okay, as you can see here, what this P&L simulator does is it shows me exactly what my expected return of each one of these strategies are based on the scenario that I just gave of the stock going up to $32, 3 days after earnings, and the volatility comes back down. So if I bought the stock, I make a 4% return. Nice. If I bought this call, I'd make a 52% return. If I bought this call vertical, I make a 55% return. So this is the basis for how you're going to start looking at different strategies and seeing, hey, how am I going to perform if this thing beats earnings? Am I going to make enough money for me to risk this type of capital in order to place this trade? The P&L Simulator will help you answer that question very easily. So let's take a look at what happens if the stock moves a little higher. What happens if the stock really blows it out of the water and goes to $35? So as you can see, if it goes really out of the money, here I make a 14% return on the stock, a 312% return on the call, and a 170% return on this vertical. So if I really expect Bank of America to really blow it out of the water, this strategy here in the middle is the best. If I expect a modest beat to $32, then this strategy here on the right is the best. If let's say Bank of America does nothing and just stays right there, then if I bought the stock, I'd make pretty much nothing. If I bought this call, I'd lose $36. If I bought this vertical, I'd lose $21. And what happens if Bank of America misses on earnings? What happens if it goes down to $27? This is something that we've seen happen. So if this thing goes down to $27, here I lose $365 if I had bought the stock. Here I lose $108 if I bought the call. And here I lose $87 here on the right if I bought this call vertical. So this is where you should take a look at using this tool, not only for if you're right, but also for what happens if I'm wrong. Okay, so you can start using this tool to very quickly find strategies that help you make a bet on earnings with limited risk. Okay, so I just took a Bank of America as a quick example. I'm going to look at Netflix because here's a technology stock. It's going to report earnings in 11 days here on January 22nd here at the very bottom. So if you ever type in a stock and you want to know when that next earnings or dividends payment is coming up, it'll tell you right here at the bottom of this page. Okay. Now with Netflix, I'm going to go through a slightly different example because we talked about using calls in order to trade earnings on limited risk. And we talked about using expirations that are about 2 to 3 weeks out from expiration. So today what I want to do is show you guys some different examples so that you can see how you can use this platform to choose what is the right expiration date, what is the right strike price when you're trying to buy a call or a put for earnings. So by default here, I have the February 23rd, 2:15 call. I'm going to click on the modify button and I'm going to change my expiration date. So this thing reports on January 22nd. So maybe I might choose roughly that February 9th expiration. Okay, I'm going to pick an at the money call at the 2:15s. So I'm going to compare a February 9th 2:15 call. What I'm going to do is I'm going to actually change these strategies on the left and the right so that I can test out different expirations and strike prices. So let's say instead I'm also going to look at a call, but I'm going to look at a February 2nd 2:15 call. So I have the same 2:15 call for February 9th. Now I have the same February 2:15 call, but I'm using February 2nd expiration. And maybe I'm going to choose this third one on the February 16th expiration. So now I can compare the same strike price across 3 different expirations on what happens if Netflix is to beat earnings. So I'm going to go back to my P&L Simulator. So we know that it reports earnings on January 22nd. So let's put this on a date of January 22nd. Let's give it a few days afterwards. Let's say January 25th. The current volatility is 38%. We know that comes down after earnings. So let's say it comes down to 27% right after earnings. And Netflix is at 217 right now. So let's say what happens if Netflix goes up to 225, a small beat, a small modest beat. So as you can see, if it goes up to 225 a few days after earnings, if I bought the February 2nd call, I'd basically be flat. If I bought this 2:15 call, I'd make a 2% return. If I bought this February 16th call, I'd make a 4% return. None of these look particularly attractive, and this is what I meant. Not only do you have to get the direction right, you also have to have a large move in your favor in order to be profitable. So here, the stock did move modestly higher, about $8 higher on earnings, which is still a couple of percentage points. but you're going to not make much money from any of these strategies here that you've chosen. Okay, meaning the stock needs to move higher. So the stock, let's say what happens if it moves up to 230. The stock moves up to 230 here. If I bought this short dated call, the February 2nd call, make a 46% return versus 39% return versus 38% return. So not a huge difference, but you're starting to see a slight difference in return depending on which expiration you choose. Now, you can do this also for other strategies. So even if there's no earnings coming up, you can still use this tool to help you compare different expirations, different strike prices. I'm just using this as an example. So the stock really needs to move significantly. If the stock moves to, let's say, 235, which is about $20 out of the money, here I make an 86% return versus 80% return versus 75% return. So this is where you generally, again, want to trade options that are 1 to 2 weeks out after earnings. If you start going too far out, you're just not going to get the type of returns that you might want on a short-term move. But it does require a large move in your favor in order for these strategies to be profitable. Conversely, if the stock moves against you, if the stock moves down to, let's say, even if the stock stays where it is, you're going to lose roughly 50% of your trade just to time value and volatility. So that's why you need to make that up with a large move, large directional move in your favor, because you're losing money on time value and you're losing money to volatility. You have to make it up using the directional move, if you will, and you need a large directional move in order for that to happen. Okay, so I want to just bring up one last example. Schlumberger, this is one of the energy companies because this is one of the sectors that we've identified. XLE is an interesting sector. I'll bring this chart real quick. As you can see, energy was kind of stuck in a relatively small uptrend throughout September and December. For the most part, it really was range bound up until this late December time when oil started to rally. That's really when we started to see a large move up in energy prices or energy sector. And that's where kind of what we're looking at today is Schlumberger, which is an energy company. And we're going to be looking at some strategies on how to take advantage of Schlumberger. So like I said, let's choose an expiration that is just a few weeks beyond the expected earnings date, which is January 19th here. So let's choose February 2nd, for example. And what I want to do now here is instead of looking at different expiration dates, I want to look at some different strike prices. So here I've selected the 77, which is the at-the-money strikes. Why don't I take a look at the 76 versus the 77 versus the 78? So this platform, again, is designed to allow you to very quickly set up different strategies side by side and be able to make the comparison. So here, I have Schlumberger. I have the same expiration February 2nd, but I have different strike prices. I have the 76, which is an in-the-money call. I have the 77, which is the at-the-money call. And I have the 78, which is the out-of-money call. And I'm doing this because if you're trading options, a lot of times you ask yourself, what should I trade? Which strike price should I trade? Which expiration should I trade? This tool allows you to quickly help you define that. So Schlumberger is at 77 right now. It reports earnings on January 19th. So let's first bring it down to January 19th plus a few days. So let's say 3 or 4 days after earnings on January 23rd. Volatility is currently at 25, so we know that will come down after earnings. So let's say it goes down to 20%, and now let's see what happens if the stock stays where it is. If the stock stays where it is, this is the amount of money you'd expect to lose. 37% on the in-the-money call, 48% at the at-the-money call, 60% on the out-of-the-money call. Okay, so let's say what happens if the stock moves up to $79. So a small beat on the stock moves up $2. Here, as you can see, if you had bought the in-the-money call, you make a 21% return versus a 13% return versus a 2% return. So if you buy an in-the-money call, you're going to get a larger return if the stock moves a small amount, okay? But what happens if the stock continues moving higher? What happens if it moves up to $80? So as you can see, if it moves up a little bit more, this at-the-money call is going to give you the highest return. Conversely, if the stock continues to go higher, then this out-of-the-money call will give you the highest return. So this is designed to show you how each one of these strategies will perform depending on what scenario you think is going to play out. Okay, so if you think energy is going to have a blowout quarter and they're really going to do well, you want to trade these strategies with a further out of the money call, and it'll be a cheaper trade. You'll put less at risk, and if you're right, you're going to make a larger return. But if you don't get the large move, you're just simply not going to get the same returns as if you bought an in the money call. Okay, so with that, what I do want to show you is one last thing is, so once you've placed a trade, once you've looked at a trade and you've decided, for this particular trade, I think it's going to make a mild move, so I'm going to trade this in the money call. One of the things that we've built here for you guys to make it as easy as possible to trade is you click on the trade button. Number one, what I recommend is before you place every trade, take a look at what we call the strategy checklist. This is designed to make sure that you understand the risk of all of your trades before you place them, okay? So we'll check if you're trading with the trend of the stock. We'll check if you're trading with the trend of the market. We'll look at the options play score, the earnings date to let you know if there's earnings between now and expiration. And lastly, we look at spread and liquidity. So here, everything looks pretty good. We're aware that there's earnings because we're making an earnings play here. The options play score is okay. It's not great, but it's okay. On some of these earnings plays, you generally don't find great scores on these earnings plays. And once you're ready to place that trade, you hit the submit button. And what that will do is actually populate the trade ticket for you. So this way, you don't have to enter this order manually. It already enters all of the details for you. So you're buying one contract of the Schlumberger February 2nd 76 call. It will tell you what the current bid ask is. You can type in your limit order, your limit price, and click on send order. This is designed to make your life a lot easier so that you don't have to enter any option trades manually. So click on the options wizard. Like I said, for those of you that are new to this platform, take some time to take a look at this this presentation. So the webinar that we just did here today is recorded. So if you have any questions, feel free to go back to that recording, review the stuff that I talked about during the slide. Like I said, the most important thing to understand is how time value and volatility affects your call option, because you're going to need to understand that in order to say what happens if the stock goes in my favor, how much return am I going to expect, and that will help drive depending on what expiration you choose, which strike prices you choose, and also depend on whether or not you even place a trade in the beginning. So for example, if I think Schlumberger is only going to go up to $79 on right after earnings, none of these strategies look really great. I'm making only a 2%, 8% versus 20%. None of those are very attractive to me, considering if the stock stays where it is, I'm going to lose 38% or 27%. I'm going to lose more money if the stock stays exactly where it is. Probably not worth my time. The P&L Simulator will be able to help you make that decision. Is there enough reward for the risk that you're taking? If you think the stock's really going to blow it out of the water, it will show you how much expected return you'll actually see from that option. Okay, so with that, I'll just get back here. I'm going to leave this slide up, and I'm going to open this up for questions and answers. If you have any questions, type them into the webinar chat window, or you can use the Q&A window, either one. Any questions regarding what I spoke about in regards to how options are priced around earnings, and if you have a specific example you want us to take a look at, we can take a look as well. Bearish works the same way. So let's take a look. I don't have a specific bearish stock coming up with earnings. Why don't I take a look here real quick? I don't know that I have any bearish stocks. Let me see. The stock doesn't report earnings for some time. See, what does Alcoa look like? That's pretty bullish. Most finance companies look pretty bullish. Oh, That's pretty bullish. MO, Altria. That's also relatively bullish. Well, let's just say, for example, we're bearish on Altria. So first of all, what you can do is you can press the I'm bearish button here on the lower right-hand corner, and what that does is it'll bring 3 bearish strategies up here. Let's look at some puts. So this strategy, stock reports earnings on January 31st. So this February 23rd option is probably not that bad. Maybe we can look at the February options. Let's look at the February 16th. 72.5 put, the 70 put, and then maybe the 70, 72.5, and 67.5. Look at those 3 strategies. So if, let's say, Altria is currently at $70, it reports earnings on January 31st, so a few days after, let's say on February 2nd or 3rd, volatility comes down to, let's say, 15%. So the stock's at 70 bucks. What happens if the stock moves down to 68? Here it's telling you should trade this in the money put option at 72.5. If the stock moves any lower, it'll show you exactly. So if you think the stock's going to move down to $66, which is where that support level roughly is, these are the types of returns that you can expect. Or if you're wrong and Altria beats earnings, here's your expected losses, if you will, on each one of these strategies. So you can use this the same way for bearish as you do for bullish. Like I said, there's 2 buttons here on the bottom. One says I'm bullish, one says I'm bearish. So if you disagree with our indicators and you think that the stock's going to beat or miss depending on your own analysis, you can just click on the appropriate button and we'll show you strategies that make sense for that. I have another question here is, can you go over straddles? April, I would love to go over straddles, but that's a little bit outside the scope of this particular webinar, but you can use them just so you know in order how to set up straddles is you click on modify and use the same strategy constructor that I just used to create these puts, and you can use neutral strategies like straddles. So here you can do long straddle, long strangle. So you can set that up. So this is really for if you wanted to take a view on earnings, but you don't know whether the stock's going to move up or down. You think it happened in either direction. The only thing I will warn you is that when you're trading a straddle, volatility will will work against you on both sides, and time decay will work against you on both sides. So that means that not only does the stock need to move in your favor, and has to do in a large particular move, it has to even move even larger when you're trading a straddle. So as you can see, when you're trading a straddle on Altria on MO, the stock needs to move well above 1 standard deviation for this straddle to be profitable. And even if I trade an at-the-money straddle, which is the $70 straddle here, as you can see, if the stock moves up a full standard deviation, it's only going to give you a 54% return. And this is a very large move. You would have to make almost a 2 standard deviation move for this stock, for this straddle to return 100%. Vice versa, if the stock has to move substantially below a 1 standard deviation move for this straddle to be profitable. So that's as much as I'll cover here on straddles, but you can set them up clicking on modify, clicking on sharp move, and that will bring up straddles and strangles. Ed asked a really good question. What if we're not looking at earnings, but we're looking at other events? And other events are absolutely, you can use them the same way as earnings, just that these types of events usually are not known in advance. So the things like you said about the international actions, that's not something you can expect will happen. Earnings, we know when the next earnings will be. So that's why we can expect it, we can trade it. The events that you're talking about just simply happen overnight. There's no way you can trade it because you don't know that they're coming. But that's a good question. I have another question saying, when will there ever be a webinar on how to set up an account to trade option? Is there a mock screen to practice? So please, if you have questions about how to open an account and set things up, please dial the First Trade customer service. They'll be able to help you with that. They'll show you how to set up an account. They'll show you how to do all of those things that you're talking about. Another question is, what is the options play score? A really good question. The options play score is a true risk to reward metric. What do I mean by that? Most trading platforms will give you breakdowns of a trade that looks like this, and it'll tell you what the cost of the trade is, what the max reward, what the max risk is. Some of them will give you probability of profit for the more advanced platforms. It'll tell you what the break-even prices are for these strategies. Now, the reason we created the options play score is because these numbers are not always easy to get a feel for what the true risk reward of a strategy is. So as you can see here on this straddle, you see mostly red and very little green, right? That means that you have a lot of potential for risk, but very little possibility of getting any actual reward. However, when you're looking at the risk reward of this strategy that tells you it has unlimited max reward, you really can't calculate the risk reward of something with an unlimited max reward. So what we do is we solve this problem by simply saying, what is the potential for profit of the strategy and what is the potential of loss, and weight it by each other and give you a true risk reward metric. And that's what the options play score tells you. How much risk are you actually, or how much reward are you going to get for every unit of risk that you're taking? So here on the straddle, as you can see, a very poor options play score. It's telling you that it's a poor risk to reward metric versus this out of the money put or in the money put gives you a much better risk to reward on a specific trade here. So great question about the options play score. It's designed to help you better gauge your risk on each trade. April's asking, what is the highest options play score? Well, in theory, there is no highest because it's a risk to reward metric. In theory, risk to reward can go to infinity, but we do cap it out at 250, so you cannot go higher than 250. But you don't have to necessarily think about the numbers. They're all color-coded for you. So red means avoid or bad risk to reward. Yellow means okay. Green means good risk to reward. I would go by the colors more so than the actual scores. And they're all relative, meaning it's useful when you're comparing one against the other. It's really not meant as an absolute metric. It's meant as a relative thing for you to be able to compare one strategy's risk reward versus another. I have a question here on the income part. So the income part is a different part of this platform. We typically do webinars just on the income one, and maybe it's time to do another one for those of you that have not seen it. But the income is really for those of you that are long-term investors in stocks. You can use options as a tool to help you generate income. You can do it on stocks that you already own, or you can do it on stocks that you don't want to own, but you want to own. So you can either sell a cover call if you own shares of Altria, or you can sell puts if you don't own shares of Altria, but you want to own shares in Altria. So these are two popular strategies that you can use to generate income on the existing stocks that you own in your account. So keep that in mind. We also have a recording of that webinar as well. So if you want a copy of that, please ask customer service for them to send it to you. It's a great way to utilize options, especially if you're new, is selling cover calls. It's a simple option strategy that doesn't add additional risk to your portfolio, and you can do it if you already own some stocks in there. If there aren't any other questions, I want to thank everyone for taking the time out this afternoon and taking the time out to view this webinar. I hope you guys have found this useful. Like I said, if you've never used options play, please go to trading tab, go to the options section under the trading tab, and you can find the options wizard here on the right. It's a great tool that's available to you free of charge as part of your First Trade account. I highly recommend you to take a look, and it makes your options trading a lot easier to quickly help you analyze the trades that you want to make, but also for those of you that even have experience trading, it's designed to help you save a lot of time in picking the right expirations and strike prices. So thank you guys again. I hope you guys have found this useful, and I'll be back here in a few weeks, and maybe we'll do one on income strategies, especially for those of you that are new. Thank you very much. I hope you guys have a great afternoon.